Okay, good afternoon, everybody. Let's go ahead and get started. Let me know if you guys can hear my audio and see my screen in the chat box. Just give me a little Y or a yes there, just to let me know that it is indeed working. Hope everybody's had a fantastic afternoon so far. Looking forward to going over this basic training webinar with you guys today. Today's topic is going to be why trade liquidity and how to find liquidity zones. So as you guys know, this is something we do a lot in the webinars, and we talk about liquidity as good places to get great entries in the market, right? And so I want to show you guys how we go out and find those and why we trade them specifically, why the market lives and dies by liquidity, right? Before we jump into this, as always, I need to remind everybody about the risks involved in this market. You can lose all or more than your initial investment if you're not careful, so please be aware of how many pips you're risking on each trade, in addition to how big your lot size is and ultimately how that would affect your account if you were to lose money. So make sure that you're going through that process each and every time that you take a trade. All right, guys. So let's first chat about what liquidity is, and then what we'll do is we'll give you some examples, and then we will go out and share some live market examples too. In fact, one of the things I have yet to do today is I want to take a couple of trades this afternoon, get some trades posted, and so I will show you guys some examples, and we might even take those very trades. So that'll be pretty cool. So the first thing is, what is liquidity? Liquidity in Forex is the ability of a currency pair to be bought and sold in the Forex market without majorly impacting its exchange rate. When a currency is easily bought and sold without a lot of fluctuation in an exchange rate, it is considered a liquid currency. Okay, so basically, liquidity is the ability to buy and sell. It's just where the market is. It's just a market, really. Just a good market is where there's a lot of buyers, there's a lot of sellers, and that creates liquidity, okay? Creates opportunity. When is there not opportunity? When there's only buyers and then there's only sellers. Well, there's still opportunity, but the opportunities are harder to come by, which is why markets often will return to liquidity zones because of that very thing. So right now, like you look at other markets, like the housing market's been kind of weird in the last couple of years. For a time, there was mostly just buyers. There weren't a lot of sellers. Part of it was because rates were so low, and so we had a lot of people willing to buy. What happens during those times? You get expansions, right? So the housing market went up a lot a couple years ago, um, in 2020, 2021, 2022 even, it went up quite a bit. Why did that happen? It's because the market was really weird because you didn't have a lot of buyers and sellers. You had fewer sellers and a lot more buyers. And what that did is it created all of this momentum to the upside, right? When that flips and you have mostly sellers and fewer buyers, then you'll start to see an expansion down. And again, in housing, it's a little bit different, but that's how markets generally work, especially in Forex and stock trading, CFD trading, options. When you have a lot of buying and selling back and forth between each other, usually the market's in liquidity and it's just back and forth, back and forth. That creates consolidations. When you have an expansion, it's usually because there's only one type of buyer or one seller to the downside, right? So that's what you get. All right, how can liquidity help you trade? It'll help you find locations where the market is about to change directions, which is huge because if you can identify those things, that helps you take profits, know when to stop out, when to enter for a buy, when to enter for a sell. It also will help you trade where the big boys, quote unquote, are taking trades, right? It'll, like I said, it'll help you take profits and enter losses when you need to take a loss. Um, it'll help you avoid being stop hunted. So stop hunted, I don't know if that's an official like financial term, but it's been a term that's been thrown around YouTube quite a lot by a lot of traders because I mean, how many of you have ever taken a trade where you did your analysis just right, the market went the direction you want, but what happened before it went in your favor? Stopped you out just before it went in your favor, right? So a lot of people call that a stop hunt. I don't know if every single time that happens it's a stop hunt, but I do believe that often the market is trying to find where liquidity is and where opportunities and trade setups might be. And so a lot of the times people view that as a stop hunt. And I think some of it does happen. I do think some of that is real. And so if you know where liquidity is in the first place, you can often avoid, often, not completely, but often you can avoid some of your losses. The other thing that's probably the most important detail about trading liquidity is it improves your average risk to reward ratio. So I used to take when I used to take trades in the begin like 10 years, 11 years ago when I first started trading, I used to take a lot of positions where the risk to reward ratio was upside down. What that means is I was trying to make, give you an example, if I was trying to make a dollar, I would risk $2 to make that trade, where I'd risk a dollar or I'd make a dollar but risk $5 to make it. So the it was very likely that I'd win, and I'd make that money. But the problem is if you lost, you'd lose so much more than you would have made, right? So we have to flip that. Successful trading is often associated with bigger wins than losses. So how do you install that into your trading style? You have to have a risk to reward ratio where the risk is less and the reward is more. So you have to wait for specific setups. This is where strategies come in, where you have to create an edge in the market where obviously if your edge is good, then then you can have a tight stop loss and a big reward behind that trade opportunity, and that becomes very lucrative. And now if you win that type of a trade, you can afford more losses, right? It's easier said than done, but that is what we're trying to achieve by trading liquidity. So let's talk about liquidity in its detail and like the science of it. So I've kind of drawn up an example here for you guys to take a look at. So um, when you see a large impulsive move in the market, so if you see a series of candlesticks, we'll just say two, three, or four, five candlesticks, and they're all the same direction. How many of you have ever seen a move like that? Probably today. You've seen it many times. You've seen a chart where you see a big move. You've got five green candlesticks in a row or five red candlesticks in a row, and it's just a bunch of, the market's just moving up and up and up in your favor. It's moving down against you, right? That's so so impulsive moves like that, where you have big moves, those are not created by retail traders like you and me. Those are created by the quote unquote big boys, right? The banks and the institutions. They're the ones who create those big impulsive moves, right? We can't create those. So one really good exercise you guys could do, I would recommend that you do this afternoon or sometime tonight when you get some time. Pull up any chart on the stock market, forex market, gold, silver, it doesn't matter. Any market you want to look at on any time frame, preferably maybe just like a little bit of a higher time frame, like a hourly time frame and up. Go look at the biggest impulsive moves you've seen and follow them backwards to where they started and where they originated. Often that's where liquidity actually is. It's at the location where a large impulsive move took place. Okay. Um, so what happens when you get a large impulsive move? So down here at the base of this liquidity example, you have a bunch of candlesticks back and forth. You have some red candlesticks, you have some green candlesticks, and it's mostly back and forth activity. That's a market. When you have back and forth activity and you're in consolidation, that's considered a market. Why is that? Because that's the place where buyers and sellers are willing to come together and spend most of their time, thus why there's more volume at those levels, okay, inside of consolidation. Now, when the market breaks out and creates this impulsive move, what that means is you no longer have a market with tons of volume in here because somebody came in here and basically took it out of this area and said, no, we're going to go up. And so there's not a ton of buying and selling activity happening inside of those, 3, 4, 5 candlesticks that I was talking about. Most of the buying and selling activity took place down in here. This is key to understand because of what I'm about to tell you next. So when this happens, it often breaks structure. And this was the area where the buying and selling was taking place. And if the market leaves that structure and goes into like a new zone, new sphere, whatever you want to call it, and creates a new liquidity zone up there, when that happens, um, you've got these traders who are trapped down here. Obviously, the buyers are really happy. They're really glad they bought down here. And if they stayed in their buy, they're doing really, really well and they're happy. But if you have a seller that's stuck down here, how's the seller feeling when the market breaks structure and moves up into the next zone, that's 50 or 100 pips higher and they're still in that sell? Well, they're not feeling very good. And this happens all the time on different time frames, all time frames, on different instruments, happens everywhere, right? So when that takes place, if the market ever pulls back from that break of structure and it's up in this area and it pulls back into this liquidity zone that's down here, if the market ever pulls back, what do you think the seller's going to do the moment the market pulls back into this old zone? Most likely, a seller who gets trapped into a trade and has suffocated a long time in this opportunity, if they ever get a chance to close their bad trade at break even, they're going to take it. Now, if a seller closes a position, what is that actually doing to the market? If a seller closes, that's the same thing as a buy. Okay, if a seller sells an item, if you own a business and you sell something, right? Um, you're exiting that. You're basically, if you exit your position, somebody else has to buy that. Okay, that's what's going on. So it creates more demand by these big boys when that happens and when a seller exits. Okay, let's look at some. Okay, and actually, let me read this last part. Buy orders were left behind, so if given a chance, they will close or mitigate the consolidation that created the break of structure. Exactly. So right here, here's an example. Here's an example of the phenomenon. So when you have, this was what we were looking at before. So you have these trapped orders inside of this liquidity zone that's right here. And then as the market breaks up, breaks structure, and then pulls back, when it pulls back, it's not likely to continue below that. It's often just going to come back to the zone where they were buying and selling back and forth. It's going to come back to this area because this is the area where they were last found in that volume, where that large amount of volume was taking place. That's where they were. And if you were to give those sellers a chance to exit their position, they would do it. And the buyers would reload their positions, which subsequently creates another move, usually even bigger and higher than the previous move. And it breaks even more structure. And that's how you create a trend, right? That's the concept, right? So this is also known as mitigation. So mitigation is where the market comes down and touches into liquidity or the thing that created the impulse. So when the market comes back to that, it's mitigating whatever trapped orders existed in that zone, and now the market's off to the races. Okay. Let's look at some live example. Well, this is an example from a while ago. I just took a picture. So right here, you actually have a break of structure. You have a market that kind of came below this area. And it had a large impulsive move right here. It was like 1, 2, 3, 4, 5 candlesticks in a row that were all bearish, two of them that were pretty big right here. And it created a move to the downside. The market and the volume exists right in here. All the volume is tied up in this area. See this pink or purple area? That is, I think it's more pink than purple. You guys tell me. I don't know if it's pink or purple, but anyway, that is where the liquidity is right there. Okay. Why? Because that's the move. That is the area where that preceded the impulsive move to the downside. So that would be liquidity. Okay. So when the market moved down, the sellers are like, yeah, we're doing great. This is awesome. We're making money on the sell. But how are the buyers feeling that are trapped up here? Well, they're like, well, that's not cool. The market's going down. I bought up here. That's not nice. So if the market were to ever come back to that zone, a lot of the times the buyers are like, you know what? I don't like this trade anymore, and I just want to get out of this trade that I've been down on it for a while, and now the market's giving me a break even opportunity. Let's just go ahead and call it. That's what not everybody does that, but like that's what most people do when they see the market come back to that price. And then what are the sellers doing? The sellers who recognize the liquidity, so people like you and me who come in here and see that liquidity opportunity, we go in there and place even more sells. So you have buyers who exit their sells, or excuse me, buyers who exit their buys. And if a buyer exits their buy, what is that actually doing? When a buyer closes, that's a sell, right? So you have selling pressure from the buyers who were buyers in that liquidity zone who have now exited. And you have opportunists like you and me who come in and enter even more sells at that zone. So what does that do? It does this right here. So here's an example of post mitigation. So in fact, actually this is it right here. So right here, the market, you can see kind of barely wicked up into that liquidity zone, came right up into that area for a very brief period of time. And then what did it do? It slid off into the sunset, right? It just fell off right here. It kind of went back and forth. It was kind of a battle, as you can see, but it did fall off from that zone. Okay, that's post mitigation. So the market came up, mitigated whatever liquidity was tied to this area, gave the buyers a chance to get out. If they were lucky and if they were smart, they got out, and that created selling pressure, as you guys know. And it also was an opportunity for opportunists like myself and you guys to go in there and grab that sell and send it to the downside. Okay, so that is liquidity in a nutshell. Now let's look at some examples. So let's go to the live market. Here I have the Aussie franc pulled up, and on this Aussie franc, let's look at different breaks of structure. So you want, well, first of all, you want to find impulsive moves. So where are the impulsive moves, right? I would say that that's an impulsive move right there, right? You got several candlesticks to the upside. This is this is a move right here. Here's a move right here, right? Here's a nice impulsive move. Let's see if we can find some more. There's quite a few actually throughout here, right? So, and each one breaks structure. So you have, this was a structure point. The market broke above that. You have structure here. The market broke above that. Right. And then it broke above right here, broke above that. And it just kind of went just up and up and up and up. Right. So each time it breaks one of these structures, let's actually draw this out. Let's look at each pullback. Let's kind of mark up how far this market pulled back and see if there's a pattern here with each pullback. Okay, so we've got three different breaks of structure lined up here. Let's look at the base. So down here, this would have been considered demand right here. That's demand. Why is that demand? Because this is the area that created that impulsive move, that move to the upside, right? Whatever took place in here ultimately led the market to the upside. Also, right here, this box, whatever took place inside of here ultimately created that move to the upside, right? This is where the volume was. That's where that volume existed. So likely this is where, if it pulls back, this is where it would pull back to and then bounce up. Look what it did. It pulled back just to this area. It actually went pretty deep into this area, but it still went into this area. And then what did it do? Boom, impulsed back to the upside. So an opportunity would look something like this. So an opportunity would be if you identified this right here, our job would have been to say, oh, hey, look, this is a liquidity zone right here because the market broke structure. So if this thing pulls back into here, you would want to buy because whatever happened in here is where that's the market that created that impulsive move that ultimately broke structure. So obviously this would be a good place to buy. That's what you're looking for ahead of time. And then obviously, as you guys know, it pulled back into this area and then it was just off to the races to the upside, as you guys already know. Okay, so let's look at some more. Here, I'll let this finish out. This is almost done. Okay. Okay, this one also broke out right here. Where's the liquidity for this last break of structure here? I would argue that this Aussie franc has liquidity kind of in this area right here, because whatever took place inside of here is ultimately what created this move to the upside. So that's a liquidity zone right there. So if the market were to come back and dip into this, that would be pretty good. Right now, it's probably not the best time for this Aussie franc, because you have it's at a high right now. So you don't want to necessarily, I mean, you could buy, but I wouldn't buy right now, because if you buy here, you're buying at a top, you're not buying on a dip into liquidity, right? So I'd be a little bit concerned about just jumping into that one. Let's go look at some other examples. And if you guys have a currency pair that you want me to look at, we can certainly do that. It doesn't matter, like literally anything. We can go look at, I don't know if you guys have a favorite pair, maybe do the dollar yen. That's one that I like. Let's pull up the dollar yen here. This is an hourly time frame. And again, it doesn't matter what time frame you guys look at. But let's kind of go through this. Maybe we can go just find a trend here that we can look at and analyze. I mean, liquidity is pretty much everywhere and everywhere. Yeah, like for example, here, let's kind of analyze this. So, right here, this market was coming down, 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 down. It was just coming down, and then it started to break up. So you have this break of structure. You have a couple of structure points where it broke, actually. I would say, um, I don't know. I guess you could say that the market broke structure here. And you could argue that the base of that is either this thing right here, whatever happened in there. You could also argue that this is the base right here. And technically the market came right down to this. Some people just go off of the last bear candle, which would be, if they call it the banker's candle, you could go off of that candle right there if you wanted to. I don't do it that way. I just take it off of the general zone that created that impulsive move, right? And so the market did indeed pull back. The market did indeed come into this area, and then it shot up from there, right? Now, where's another impulsive move? So I would say that all of these are impulsive moves. Like that's an impulsive move there. This is an impulsive move here, right here. And also this is pretty impulsive, right? So all three of those are impulsive. So naturally, there's liquidity tied to each one of those. Where are those liquidity zones? So let's delete these and just leave those on. Where are these liquidity zones? And actually, let me actually change this up. So this is one of them right here. Let me just do this. Let's extend there. Okay. So whatever this is, actually, let's do this. This will help me teach it better to you guys. Let's do this. This is liquidity right here, because whatever took place in here, inside of that little area, there was big orders placed in there insofar that the market created this impulsive move. So naturally, that's going to be liquidity. And sure enough, the market tapped into this area later in the future. So this one happened on July 18th, and it took until July 28th. So 10 days later, the banks came back for their orders here. They came back to this liquidity that was created on July 18th on the dollar yen. See that? Pretty interesting, right? What else do we have here? So we have this impulsive move, right? So this one, yeah, whatever was created inside of here, whatever they did inside of this area ultimately created that move that broke more structure. So that's got to be liquidity. Boom. See that? See how the market came right down to it, tapped into this area, and then it went up. I know it didn't go up forever, but that's a huge opportunity. I mean, that's like 12 hours of bullish activity where you could get a massive trade out of just that move. I mean, if you'd have to get out in time, but yeah, that's still a great little move, right? Then there's this impulsive move right here, and it was created by this guy right here. Yeah, whatever took place inside of here ultimately created that impulsive move. And the market did come into this area, and it did bounce out of it initially. As you can see, it came in and bounced out, came in again, bounced out, and then it failed. So they don't all work is the way you'd like them to work sometimes. But these two, um, I mean, maybe you could have gotten out if you had seen it pulled back, but even if you had lost, I think that's okay because you're keeping your loss tight and there's other opportunities to make money. Like, for example, on this second one right here, you could have made money on that one. Boom. And then same thing with this guy down here. There's plenty of money to be made on that move. I mean, that one just went off the rails. I mean, that one, 10 days later, if you had caught this one and had a limit order ready to go right there, I mean, that's huge. Crushed it right there, right? Let's go look at some others. Like this is kind of fun. I like to do this because just learning liquidity is huge. Huge opportunities here. Um, um, okay, so where are the impulsive moves here? So this one's kind of interesting. You have an impulsive move here. The market pulled down into this area, and this is technically liquidity, and we'll use that. But this market pulled into this area. Um, I guess, yeah, it liked whatever this was right here. It liked that. I don't know if I would have ever used that one, but the market liked that and then bounced off. Um, I would have probably used this one right here. I think that's the liquidity zone. Maybe this gets tapped into later. I don't know. I'd have to look forward, but I'd probably use that one right there. I don't know if it ever got tapped into. I don't think so. So a lot of these won't even trigger, but you can see the concept, right? Let's see. You have kind of an impulsive move right here. See this? Um, and then look at this. The market came right back into this area. Because whatever took place in here is what led to this impulsive move. So obviously when the market came back into it like this, it was off to the races. Pretty cool, right? Let's continue on. Oh yeah, this is kind of cool. You've got several actually right here. You've got, I would say that this is an impulsive move here. And same thing with this one. Nice little expansion on each one of those. And each time, so this first one, you have, let's see, yeah, this first one's pretty good because whatever took place inside of here, yeah, whatever took place inside of this area is what created that right there, that impulsive move, right? So now if we extend this over, see that? See how the market comes right into it? Boom, off to the races. Boom, off to the races. Pretty cool, all right? I think that is pretty awesome. This okay, and then this one is one that failed. So I gotta point out the ones that don't work either, right? Like so this one didn't work out. Um, like that one didn't, I mean, it worked right here, but so like what I'm showing you is you have this impulsive move that starts here and goes to there. And so whatever consolidation is inside of this area ultimately created that. So that would be considered liquidity, but you can see it only worked for a brief period right here, bounced off of it for a very brief period, but then it ultimately failed. So they don't all work, right? They don't all work, which is something very important to notice. It's not like something that's 100%. Very important to understand that. Okay, so yeah, so I mean, there's a lot through here. This one came into what's called a fair value gap. So this is like when you have a single candlestick, like a news event that creates these big moves like this one right here, often the liquidity zone doesn't work out because so this is liquidity here, right? But it didn't work. Why did not, why did that one not work? And it's often because if if that liquidity zone is preceded by a major move, impulsive move that's if it's impulsive like this, where it's just like one or two candlesticks, um, it's not more like a trend that created it, then often the market will try to find what's called a fair value gap. And I don't like to trade those. Like, for example, so this actually came down just below the liquidity zone. This barely tagged beneath it, came just below the liquidity. And that happens when you get these impulsive moves that are not trend like, they're just more like one or two candles. And so that happens. And I get caught in these. I've lost plenty of money getting caught in these, and I just have to stop out. And it's unfortunate because you find out later that you could have made some money on them. Let's see. And then right now, yeah, so right now here's the dollar yen. It's been going up, as you guys know. We had a little bit of a break of structure right here. And I guess you could say there, I think more it's this right here, broke structure. And the market tapped right in to this zone. Like whatever took place in here created this move right here, which ultimately also led to that move right there. So those breakouts, and the market just came right into liquidity, and then it was off to the races, right? So pretty cool. I think it is pretty awesome stuff. Let me see if I can find some other examples. We got a few, yeah, we got time. I don't usually go the full hour in this class, but we have time to look for some more examples. And actually, the way I like to trade this, the way I really like to trade liquidity, and you guys know this is what I do, and this is a trade I was actually going to post. I still probably will. I just haven't gotten to it yet. So if you go look at the Aussie yen, this is a trade we looked at in the live trading room today. Yeah, right here. So the reason why we like this trade, let's first of all, we added sentiment, which I don't want to get too much into this because this is a different topic. But when you look at the sentiment index on the Aussie yen, most people are selling this right now. Retail traders are selling, 66% are retail traders selling. And then you come over here, most traders are selling. Let's see, yeah, right here you can see 71% sellers. And so when we come back to the chart and we know that most people are selling, who aren't very good at trading, retail traders are not good. It makes a lot of sense for us to go ahead and go against them, but we want to base it off of a couple of things. So right here, and I missed this trade, but you had a nice break of structure. Right here, you had a nice little structure point here, and then you had a break right here. So naturally, there's probably liquidity hidden underneath this. And sure enough, the market came, tapped into whatever liquidity was right here, tapped into that and went up. Now my question is there more liquidity that I can use? Can the market actually come back into this area? What I'd like is it to tap me in right there, and then I'll ride this up, because I know retail traders are trying to sell this right now. And I know the banks have an interest in sending this higher. Yeah, there's an interest in sending this higher right now. And so uh, that's what I'm trying to set up. That's what I'm working towards at the moment. Yeah, that's what I'm trying to get to. So I've been trying to debate, this is actually probably good for you guys to see, but I've been trying to debate how I want to post this trade because I like it and I want to post it in the group. But I'm just trying to decide if I just get in now at long and just write it up, because the next liquidity zone's up here. Now, why are we targeting up there? So we know we want to buy, but why are we going up here for our target? Well, it has to do with these zones. There's actually two different places. You can either target here, which I'll extend that out, or you can target up here. Why? Because whatever happened up at these 2 points ultimately broke major structure points right here. So you had a structure that was created right here, and the market broke that right here, broke beneath that. Right here, you had a major structure point, and the market broke beneath this. Let's see, here's your break. And whatever orders were placed in this area and whatever orders were placed in this area ultimately created those breakouts. So we know liquidity is trapped up in there. Plus, you can use these order block indicators, like with Sonar Lab, and they're saying that, yeah, right here on the hourly time frame, there's a bunch of liquidity right here and right here. So we know that there's selling pressure up there in those two areas, but we're not there yet. There's no selling pressure, at least not a lot, until we get up into those areas. So that's what I'm trying to work towards is how can I sell this? How can I buy this until there? And then I want to take profits at those areas. Okay. So now we come back over to the current market. So that's how you can figure. So you use liquidity to figure out your take profit the same way you use liquidity to figure out your entry, which is really, really cool, isn't that? I think that's super awesome. Now it's not support resistance, right? You're not trading off of like, okay, here's support. I'm going to put my take profit at support. Doesn't work that way. You trade around liquidity, not support resistance. Okay. I probably did support and resistance for 3 or 4 years when I first started. And I was like, now I'm like, oh, wow, why did I do that? Right. Anyway, you learn, right? So now I'm just trying to figure out my entry because I have a pretty high level of confidence this is going to continue higher. Um, but I'm just trying to figure out how to do it because the tighter I can get it, the tighter I can get my entry, and the tighter I can get my stop loss and get away with it, the better the most money I'll make, right? So for example, if I can get this market to come down here to this area, and if I can just stop out right there, holy moly, I can make a 1 to 6 on that trade if I can get that to work. That's the big question though. If I just buy now, see, watch this. Now, if I just put this right here and I just buy now, look what happens. So it's still an okay trade. Maybe not that okay, to be honest, but you'll make 1 to 1, yeah, 1 to 1.36. So a little bit better to 1 to 1, but it's still like you're not making a ton of money off of that trade. You're making some money, which I think some money's better than no money. But if you can get a 1 to 6 or a 1 to 5, that's game changing, right? You know how many losses you can afford if you can get a 1 to 5, 1 to 6. Like that gives you so much confidence to trade really well going forward if you can capture that. So that's the big question is if I can get away with that. And the thing is, if I go down here, what if the market never comes down here? What if it just goes straight to my target without triggering me in? See, there's that other risk. So that's what I've been contemplating all morning with this trade because I want to get us as a group into this position. This is a trade I want to take as a group. I'm just trying to figure out how to do it. You can see how there's so many different ways to do it. Um, I think the more solid way, the guaranteed way, is if I just buy now, um, because then there's no risk of missing the entry because you're just buying now. But then your RR ratio is pretty bad. I've noticed that about market orders. It's really hard to get really good RR ratios if you just take market orders. It's just market buy, market sell. If you use the limit order, which is also known as a pending order, the RRs are a lot easier to get. Um, but you will lose more trades with limit orders than you will with markets, in my opinion. But at the same time, your RR is going to be really, really good. So there's that cost benefit analysis that might be worth looking into. Okay, so this is what I'm thinking about. Anyway, I'm not going to take, obviously, this is basic training, so I'm not going to take this right now, but I'll probably post it later. Um, and yeah, like I said, I'm just trying to figure out how to get us into this trade safely and effectively. Um, just try, and yeah, if I can get something like that, even that's a 1 to 3 or almost 1 to 3. Not too bad. All right, guys. Any questions before I wrap up about liquidity? Any examples you guys want me to look at before I go? I think this was a highly effective webinar. where we were able to go over like what liquidity is, how it sets up, and then why the market trades based off of liquidity zones. So, all right, I don't see any questions, so we'll go ahead and wrap up. Really appreciate you guys. Have a fantastic rest of your day, and we'll see you guys in the next webinar. Thanks for coming.